Good day, all. It's not such a great day for the markets this morning, though they are off their lows so far. And we know, obviously, it's Friday and anything can happen going into the close. Will markets be risk off and looking into the weekend and, more importantly, to Monday's virtual hearing with the top four CEOs of Amazon, Facebook, Apple, and Google, facing down the House Judiciary Antitrust Subcommittee. Will that create some fireworks? And are what we see have what we have seen over the last few days, if not almost 2 weeks now, in terms of volatility in the tech sector, a reflection of what might be feared coming out of those hearings? Because we know that the politicians on both sides of the aisle are going to take the opportunity to pillory the companies for all of their negatives, including issues of antitrust, including issues of opinion making and shaping, and control over markets, et cetera, et cetera. So there's a lot to worry about in terms of these tech companies facing down the House. Well, that proved to be a continued negative on Monday remains to be seen. More importantly, perhaps, will it prove to be a negative going into the close today? That remains to be seen. Wouldn't surprise me to see a sell-off into the close based on how we opened and based on how markets have been trading rather thinly today, but not as thinly in terms of volume as they were yesterday. So we're seeing an increase. We're seeing a pickup in volume today, and that may be a reflection of a lot of positioning going into the weekend. A lot of things in focus today besides tech. Tech probably number one in focus, and heading up that the names in focus in the tech universe, Intel would be number one. Intel's earnings were I think, fabulous beat, about 20% over revenue expectations, 16% better than expected beat on bottom line, an additional $1 billion over the quarter that was unexpected, and the firm guided positively for the full year, something we haven't seen a whole lot of in the earnings we've heard so far this quarter. So in spite of that, the stock is getting beaten up. Why? Because there's talk, and it's coming from Intel itself, that number one, the new chips that Intel has been promising are yet to be in production. The delays continue. Investors don't like that. On top of that, there's actually talk that Intel may move to outsourcing the manufacture of its own chips. So analysts don't know quite what to make of that, and certainly don't know what to make of the delays. And that's causing Intel to obviously get beaten up in here, and it is pulling down some of the indices for sure. Big cap stock, the largest chip maker in the world, under pressure, and may continue to experience pressure until there's an understanding of what their future plans are going to be in terms of production and in terms of the delay for the new chips. So Intel weighing heavily on markets today. We'll get back to techs in focus because that's going to be probably the primary subject matter for our talk today, because we're going to take a look at each of them and see how they fare, because some of them, in terms of their technicals, have turned a bit to the ugly side. Have they broached some of support levels and some channels? Yes, we're going to take a look at that, and that gives, or should give, us pause, because obviously tech has been the leadership group, and I don't see any immediate makeup for some of the losses and for some of the volatility. In fact, I think that's probably going to increase. So we'll take a look at each of the big tech names and analyze what they look like technically. The dollar is in focus today. The dollar's in the dumps. It's been in the dumps, and the euro has been moving steadily higher against the dollar. So has Japanese yen. The probable cause for that is the stimulus package in Europe. Now, the stimulus package in Europe obviously implies more money printing from the ECB. That, however, doesn't seem to stop investors from thinking that European stocks and markets are undervalued relative to perhaps somewhat overvalued or richly valued U.S. equities. And there has been some movement out of U.S. equities, euro buying, dollar selling, in order for big investors to place bets over on Europe as they play catch up. The PMI numbers from Europe today were both positive in terms of services and manufacturing PMI, both of them north of 50-yard line, which is the dividing line between expansion and contraction. So seeing expansion for the first time since the coronavirus crisis hit in both manufacturing and services PMI numbers. So that's a positive, and I think that's perhaps going to pull more money out of US dollars into euros in that sort of, we call it flip side trade, because we experienced dollar strength as a lot of European money came over to the US and invested in US assets. Now we're seeing a little bit of that reverse. Same thing is happening with dollar-yen relationship. Dollar is being hit against the yen. So if that continues, that's not a bad thing for US multinational companies. It's just not bad in the sense of accounting. They sell a lot of goods and services overseas, and when they translate back the money they earned here, they translate it back into a cheaper dollar. That's better for them. Their on accounting basis, their earnings look better. On a constant dollar basis, that's usually figured out, and most folks don't even look at the constant dollar basis. Of course, if you're really digging through the earnings, you're going to have to look at earnings on a constant dollar basis. But in terms of the prima facie view of earnings, U.S. multinational earnings will look better as the dollar continues to go down. So that's a positive. It's not being reflected necessarily in the S&P or any of the multinationals right now, but in the longer term, that if that trend continues, that will be a positive for earnings. Gold is certainly in focus. The glimmer is back, and gold is traded above $1,900. It's heading towards its highs of 1921 and some change, I believe. And right now at above 20, I think we might have just eclipsed 1900 and fallen back underneath that slightly. But 1900 is the highest level since 2011. So gold looking strong. The glimmer is back and probably will continue. What's going on in gold seems to be something of a flight to quality safety trade, as investors worry increasingly about money printing all around the world and some signs of incipient inflation. So gold getting a bid, has been getting a firm bid for some months now based on a lot of factors. What's probably most important to zero in on in terms of the demand for gold is it's from the investment side. It's not coming from the retail side. Typically, over the last decade or so, the principal demand for gold has come from retail. It's come from China and from India, moreover. We're not seeing that with the coronavirus crisis affecting both China and India. Retail gold sales are down dramatically. So the investment community are picking up the slack, and demand is coming from investors. So that tells us a little bit more about what investors' view of the global economy is and of money printing and the potential for some inflation. So don't know that gold's going to stop. No reason for it to stop because the the conditions for its ascent haven't changed. So I can easily see gold eclipse its all-time highs and certainly continue on from there. That's the picture in gold today. There's a dust up that is also worrying, I think, not only investors on both sides of Europe and the US in terms of tariffs, but it's also impacting, I believe, investors in the tech sector, principally on the mega cap tech stocks that we always watch. Boeing and Airbus have obviously been heated rivals for commercial jets for a long time now. What's just come out is that Airbus has had over the last, I didn't catch the time frame, but over a recent time frame, and again, I'm not going to speculate on what that was, has had at least $18 billion in subsidies and government subsidies and supports to help Boeing, to help Airbus in its fight against Boeing to sell aircraft. Boeing claims that that distortion has cost it the sale of at least 300 planes, and complaining vehemently to WTO. So as that battle heats up, I think that the United States may put more pressure. Certainly, President Trump has been inclined in the past to put pressure on Europe in terms of threatened tariffs and actual tariffs, and this may ratchet up that again. Again and again and again, we come back to the tech companies. In the middle of last month, what happened at the EU, that the EU Commission allowed for services and IP, intellectual property, to be put on the list of goods that are subject to tariffs in retaliation for tariffs that the US may impose on European goods and services. So that puts fresh pressure on the tech sector. Why? Because that rule change was specifically designed to point a finger at US tech as a warning that if there were going to be some tariff wars, US tech was now going to be directly in the line of fire. It's another reason that the tech sector has been choppy and certainly sloppy over the last couple of weeks. And we know, obviously, with the hearings coming up on Monday, there's just a lot of volatility in the sector. It's held up so far today. The Nasdaq Composite got hit pretty hard this morning, has made a comeback, is still underwater, and is still down more than the other benchmarks, but not by a whole lot. So it's made a pretty decent comeback, still to the downside by about 2/3%. And in my mind, holding up pretty well, all things considered. But we're just barely at the middle of the day, at just coming into the noon hour. And generally speaking, we see a slowdown in trading around now till 2 o'clock, where things start to pick up again going into the close. So remains to be seen how we move forward in that environment. So I'm going to go into the tech stocks and get a little more specific on the tech stocks that are in focus today, and take a look at all the charts. But first, let's go see what kind of questions we have and see if I can address some of those for you. Pat is asking, do you think the dollar will continue to go down? Yes, currency markets are generally very trend oriented. And once a trend begins, it tends to run for some time. It can be months, quarters, and longer. Some of the numbers I've seen in terms of euro dollar are the euro perhaps getting to $1.20. So that would be a pretty big hit for the dollar. So yes, I think the U.S. Pressure on the U.S. dollar can and will continue. An additional stimulus package in the U.S. may do something to stem that, depending on the shape of that stimulus package and whether or not it's a handout or whether or not it actually serves business and the economy. So that remains to be seen. Of course, we're not anywhere close right now to another stimulus package, though certainly the parameters of one of a couple of different ones are being architected as we speak in the halls of Congress. So that's my opinion of, yes, Pat, UDN. UDN, everybody, is an ETF, which is the US dollar down against the euro. And this is the ProShares Ultra Semiconductor. No, UDN is your semiconductor. You're thinking of, oh yeah, UDN. I'm looking at USD. Sorry, I punched up the wrong thing. Yes, as far as UDN, and for everyone else out there, UDN is the Invesco Deutsche Bank US Dollar Index. It's a bearish fund. UUP is the Invesco DB US dollar bullish ETF. So if you think the dollar is going down against a basket of European and other stocks, specifically really that the euro, then yes, the UDN is a good play. If you look at the chart, it's obviously at its highs, and if you believe the dollar is going to get hit a little bit further, as I believe it probably will, and yeah, it's maybe not too late to take a position here and try and catch a little bit of that move. Ruby, how about the Qs? How about those Qs? We're going to take a look at them, Ruby, and graphically, because the Qs obviously represent the Nasdaq 100, and we're going to take a look and see if they have broached some support, if the technicals are under pressure, and I won't I won't keep that a secret. The answer is yes, they are. So we're going to take a look at those, and we're going to take a look at the FANG stocks, Microsoft, Intel, and just take a look and see exactly what sort of pressure may they be facing in terms of their technicals. Michael's asking thoughts on the Cobra effect, Fed causing more harm than good in the end. In the end, whenever the end comes, remains to be seen, Michael. Yes, in the long term, there is going to be some fallout from the Fed's actions. It's heavy-handedness, as necessary as they perhaps deem it to be. And in terms of the stock market, I would have to say it has been the Fed's buying of corporate bonds and all the other liquidity measures and programs it's enacted and resurrected. Of all of those, buying corporate bonds stands out to me, including credit ETFs, stands out to me as being unprecedented, beyond the scope of what I expected that early in the market's turmoil. And that's why the markets rallied. That is the ultimate support, other than buying equities, that the Fed could provide, is to backstop not the equity market, but the bond market, which represents the credit structure of so many companies. That supports their equity and gave investors a pass to go on in and take risk on positions. So yeah, is it good? It's helped. Is it infinite? Could be. Will there be a reckoning? Yes. When? Nobody has any idea. If you look at Japan, they've been doing what the Federal Reserve has been doing lately, and for the last decade, been doing it probably for 30 years. And they are buying Japanese equities. And it hasn't really had any major repercussions, especially any of the ones that so many analysts thought would have come to pass. None of them have come to pass, other than slow economic growth. However, what's worse hasn't come to pass. So that's where we are with the Fed. It's all good until it isn't. Shelley, hi Shah, hi Shelley. How do you know how long the congressional hearings may go on? Well, I believe it's just Monday for the House. I don't know if the Senate has convened hearings yet. They, to my knowledge, they haven't, and I don't know that they will. Of course, they always could, but it's just the House on parade on Monday, and I don't know what the time frame is for it. Though those hearings generally do have a time frame, I don't know what it is. Probably, at least my guess is a few hours. So it's going to be high drama on the television. I think all the financial news stations will certainly, if they're not covering it fully, will intermittently cover and show live versions of it. But I do believe there's going to be probably at least one or two channels that are going to have it on live. I know I'm going to be glued to it wherever I find it. Ruby, good time for some defense stocks. Yeah, not a bad time. It's never a bad time to take profits. It's never a bad time to set up some defensive plays. So yes, but we're not there yet. We're not out of the good times, out of the uptrend and in trouble. Yet, we are certainly a little bit more on shaky ground than we have been in some time. And we're going to take a look at that again based on the major indices and the tech sector, which is experiencing most of this tumult. So let's go take a look at that right now. And then I'll come on back and see what other questions you all have. So let's go take a look at the tech stocks and the benchmarks and gold and the treasury market, because those are all being impacted by what's happening. So first up, gold. This is, generally speaking, a pretty straightforward equation. We know really where the demand is coming from. It's coming from investors. It had been coming from central banks. Now investors are boosting gold in the safety play, and also in just as a precautionary trade against bonds, which have no yield. Yes, they have some yield, so to speak, and could have a lower yield, which means there is still some potential appreciation possible in bonds, in treasuries, in so-called risk-free investments, whereas there is no yield in gold. So investors moving into gold know that, and if they're willing to bid up gold, it means that gold could have higher to go. So here we are. Certainly looks like a pretty healthy picture, and there's no reason for gold to start backing down. So again, if you own gold, I certainly would hold on to it. I think it's going to easily eclipse its highs of 2011, and I believe make really considerably higher highs, because all the conditions remain intact for that to happen. Let's have a quick look at the benchmarks and see if there's any damage being done to them. Well, first up is the Dow Jones Industrial Average. No damage. So we're taking a look here. The Dow is still, as you can see, above that sideways channel. It's in pretty good condition, above its 50-day, above its 200-day, above its 20-day moving averages. So really, there's no major damage. It's moving a little bit sideways, not a big deal. So I'm not worried about that based on this chart. What would worry me is if the Dow comes down here. And let's take a look at this bar here. Today, this is today's bar, and you can see we opened down, but not a lot of movement subsequently. The 200-day moving average based on this bar is 26,234. So at 26,234, we are at the 200-day, and that's something investors are going to take notice of if we break down below the 200-day. That could be momentarily problematic. Doesn't mean that we're going to continue down. It just means that investors are going to take notice. If we continue down and the 200-day falls through the 50-day, that's not going to be good, because we will be outside of this channel that we've enjoyed for some time, and potentially create a little bit of how should we say, put this politely, agita for investors who are principally looking at pretty much an uptrending channel right here. And so far, so good for this channel, whether you can draw it from the very bottom or we can draw it. Sometimes it's good to draw multiple trend lines. We can go from here and see where we are. And there we are a little better off if we use that. But we're still also pretty close to coming down to this trend line here. So we have this, just drawn this trend line here. If we get down to this trend line here, we are pretty much, again, we're on the 200-day. That's going to concern a lot of investors, because here we are, we're at that support line. If we break that uptrending channel line through the 200-day, that's going to bring on some short sellers, going to bring on some profit taking. So not the best. Let's go right to the Nasdaq Composite, because this is the benchmark that has sustained the greatest volatility and tumult and here we see what's happened here. So we're going to get rid of this bottom trending channel line. We take a look at the resistance here, continues to be pretty automatic in terms of nicely ascending. We'll just move this whole thing up, and nicely ascending upward trending channel line. Great. Really not causing a problem in terms of resistance, because stocks are certainly moving in a very healthy fashion within that channel. So where is the bottom of this channel? We can draw it from here, and we can take a look at the channel there. That's a pretty good channel right there. And if we draw that channel, well, I actually don't like that. I'm going to draw this channel from, let's see how it looks from down below. Go all the way here and see if we have anything that would give us a little longer term perspective off of the bottom. And if we do that, we got a little bit of damage there, ladies and gentlemen, and that's not necessarily a good parallel channel, but certainly I think any which way we draw this channel, we're below any of the levels we would like to be below, and that's not a great position to be in. Does that mean that we have broken through anything? No. We're right there on this channel. We are just right there. So if we use that as the uptrending support, then we're right there. Any way you cut it, any line you want to draw, any support, lower support channel marker we want to delineate, we're there or slightly through it. And that's what was worrisome, I think, for tech investors, because that implies more profit taking. As we get pierce that, as we see increased volatility in tech, we're going to probably see more profit taking, again, because there are so many profits to be had. So that's what the Nasdaq is facing. Let's just see real quick. Let's take a look at the NDX, and it's the same picture here. That's the X Tech, and let's go look at the Qs. Look, that's probably a clearer picture to look at in terms of a lot of you have the Qs. And I know that I was asked about the Qs. So here's the Qs. Again, most investors who are playing the tech sector aren't using the Nasdaq Composite. They're using the triple Qs. They're using this ETF to bet on tech. And that's why it's really important to keep an eye on what this particular ETF is doing. So we got a wide berth there. I don't really like that. We can draw all kinds, and we're going to draw all kinds of trend lines to see if there's anything that makes sense that would worry us. And bottom line is, it's pretty much the same as the composite. We're either just on this bar, today's bar, we are either just above this short-term support, or we are through the longer-term support. Okay, so that's really what we want to, and we saw the same thing in the Nasdaq Composite. So on the short-term basis, we're not there yet, but we are through the 20-day, and again, that's starting to worry some investors. You want to take a look at this little flag area over here, and this is what investors now are, in the immediate sense, are looking at as, okay, are we going to see some support right in here, right where we are? This is what investors want to see. Can we hold that line? If we can stay above that line, then yeah, a little bit of sweating going on, but no major damage. And then we can see if we can continue. But I don't know that the market has the strength this afternoon to hold that line going into the weekend and knowing what we have on Monday. So a little bit apprehensive about a rally into the close. Nasdaq is now off. The composite is now off 1%. It was off a good bit more, but it had come off of its lows, was moving higher, and it seems that that ascent off of the lows seems to have stalled for the time being. All right, let's hit them all one by one. Let's start with, we're just going to hit the fangs. I'm going to talk about these stocks. Why? Because Mark Zuckerberg is going to be run down, pilloried, in my opinion, at the hearing on Monday. So how he acts, reacts, what he says, and what questions he's asked are going to be important for investors on Monday. Very important for the stock. You can see a tremendous rise, but we've broken through today the 50-day moving average. Now, we broke through, we charged through it here on this bar, but then rose above it and closed above it. So that was scary on an intraday basis, but ended up closing the day above the 50-day. What did we do the next day? Just trucked on right back up into positive mode, came back, made new highs. Wow. Okay. No harm, no damage. Here we are through the 50-day again. Now, this time we may close below the 50-day, which is different than this bar here. Quite a bit different. Even though on the previous bar, we did close below the 50-day, just slightly. That's scared. See, this is what happens the next day. You see where we opened up. We opened up. This is the opening right down here. So this is where we opened, and then we went lower on Facebook before Facebook recovered, made a tremendous intraday return back up above the 50-day. Is that going to happen today? It could. I wouldn't bet on it, but it could. However, closing below the 50-day, and if we close on the lows today, then I think investors are going to get very nervous. And at the prospect of sounding like a broken record, we know why. What's going to happen on Monday. So there you got a little bit of support right there, nothing major. You've got a little bit more, a little bit lower, but now we start breaking down if we're actually trading through this. So reason perhaps to consider hedging if you have a ton of profits there. Reason to have perhaps for taking some profits. Yes, in my opinion, I'm a trader. For me, yeah, there's that certainly justifies taking some money off the table. If it goes back up, great, I'll buy back in. But I hate to leave money on the table, and anything can happen by the close, and anything can happen on Monday. And nothing good is happening as a backdrop, by the way. So there's Facebook for you. Zuckerberg facing the music on Monday. Now, Apple. Most of these stocks have very, very similar patterns. Apple's obviously is not as sloppy as Facebook's, and its ascent has been a lot cleaner and meaner to the high side. Just terrific, parabolic practically, and then a pretty ugly breakdown. So is that cause for concern? Yes. It's because investors see that. They recognize that all of a sudden the stock has dropped considerably, and no real negative news coming out of the company, just prospects of what will the earnings be, what's going to happen on Monday, what's going to happen with the digital tax in Europe, what's going to happen with China, on and on and on. And that's enough to cause some pretty hefty profit taking. Well, we're coming right down to, on today's bar, getting close to the 50-day, which on today's bar, the 50-day is actually $350.89. So we're at 368.55 now. We got a ways to go if we were going to go down there. Entirely possible that we could get down and touch the 50-day, perhaps into the close if we get an ugly sell-off into the close. So that it doesn't, believe me, there isn't a trader who trades Apple that doesn't see that chart. It hasn't looked at that chart, doesn't know that that tremendously steep appreciation has been pierced. Believe me, they know. So yes, is it time to take some profits on Apple? Sure, why not take some money off the table? Maybe buy some puts. Again, if we get a turnaround, and we know we can, then sure, buy back in. But me, I'm a cautious fellow. I like to ring the register, and believe me, I probably would have rung the register yesterday, because sometimes I'm like, okay, that's it. I don't like the action. We've broken down to a trend. It's dramatic, and I'll go to the sidelines and see what happens the next day. Of course, I would have been happy had I done that, because today is a bit of a down day. Again, we're okay right now, but we haven't closed. Apple. So we've got um, Tim Cook facing the music on Monday. Also facing the music on Monday, one of the CEOs who's probably going to draw more attention than any others, because it's not often we see Jeff Bezos speak. We've heard Mark Zuckerberg quite a bit and Tim Cook quite a bit. And we'll see the CEO of Google's Alphabet speak, but we don't hear him talk a whole lot either. But certainly the richest man in the world is going to draw a lot of eyeballs. So here's what the stock looks like. We can get rid of this. We saw what happened there. We broke out of that nice uptrending channel, and when we broke out of that, we went off to the races. So now where are we? Do we have anything to worry about? Yeah, let's see. I think we do, because we're right down against that uptrending channel, having slightly pierced it today. Not right now, but on the lows of the day. Is that problematic? No, not really, because we haven't closed yet, and we're well above that. If we close below that, is that problematic? Yeah, it's going to shake some investors out. And again, that may cause, something like Amazon stocks selling off can cause all the other stocks to sell off. Same with Apple. All right, Facebook is going to do its own thing, but generally speaking, they're probably all going to move in unison. If one gets hit, they're all going to get hit. So we'll see what Mr. Bezos has to say on Monday. But again, precarious position after making tremendous run higher. Do you take some of your money off the table if you didn't take it off, north of 3,000? And by the way, not a lot of folks did. I don't blame you if you didn't, because when you get up to a level like that, the way Amazon got up there, I wouldn't jump on the bandwagon and just magically take my profits. I wait to see some kind of breaking before I said to myself, well, at least take half my profits or start to peel off some of my winnings. But this was pretty quick, pretty ugly. That might have scared a lot of people out. This might have brought some back in, looking for another leg up. But now we got a little bit of a double top. We got a little bit of I barely call that a neckline, but we got a little bit of support here. And below that, not so comforting. And Mr. Sundar, forget how to pronounce his last name, from Alphabet, also known as Google, will be appearing live via Skype probably on Monday. And again, going to see what these CEOs have to say. So pretty much this is really, we're just going to move that, and we got lots of support there, but we're not anywhere near there. So what we're worried about is this minor trend up here. Is this something to worry about? And the answer is yes, it is. Similar pattern with all of these stocks, pretty much where they are. You have a similar pattern where they've all come down to some kind of place where investors are looking at support and saying, well, hopefully they don't break down through there, because above there is safe, below there is shaky. Not bad, it's just shaky, and shaky causes investors to sell. It causes profit taking. So that's where we are with Google. Those are the four big mega cap tech stocks that are facing the music on Monday. Mr. Softy, Um, Same picture. Again, Mr. Softy's broken down. It's come through this uptrending channel here. Most recent one I've drawn, and we're through that. Again, coming down to the 50-day, starting to get scary. The ascent of all these companies doesn't mean they go up forever. It just means you've made a lot of money if you've ridden them. Does that mean the ride is over? No. Everything in place for these stocks to go higher? No, not anymore. Now we're starting to see the backside of the ascent for the mega caps. Now we're starting to see and hear what headwinds they face after their tremendous run up. We're not done, perhaps. Perhaps we are. We're at a point where we could go either way. So that's obviously gives folks reason to pause. A couple of other companies, real quick. Disney, a lot of folks own Disney. Broken through here, still moving sideways here. It's broken down through its 50-day. It's still way below its 200, below its 50 today, and broke through its 20 and 50 today, depending on where we close. We were probably in a sell-off, certainly closed below both of those benchmarks. Disney, again, we tried to open the theme parks, had issues with the employees, the revenues just being eviscerated right, left, and center for Disney, including its ships, and certainly the theme parks, and production of its features, on and on and on. So very problematic for Disney. Wouldn't surprise me to see Disney take a hit, certainly come down, test 110 or perhaps 108 and change. It wouldn't surprise me one bit to see Disney come down. If the market's coming down, we're getting soft, then I can almost guarantee you Disney, you're going to get an opportunity to buy Disney lower if you like it. And I like it long term, but I'm not buying it here. I am not sold on the timing of Disney. And I'm not going to apply a lot of capital to Disney right now when I don't know how long it's going to take for it to recover. So at some point, if it gets cheap enough, I'm going to take an initial position. Same thing with Boeing. Not convinced that Boeing is out of the woods by any stretch. Again, another issue with the 737 MAX. I believe it was 737 MAX. Maybe it was just a 737. I caught a glimpse of a headline earlier that all of the tarmac parked planes now are having their engines tested. Why? Don't know. It was just a blip headline. I'll have to do a little further investigating to see what that means. But Boeing stock on the day, hanging in there, but overall under pressure and not in a particularly strong place, in my opinion, even though right now it's holding on. All right, so I think we caught most of what we want to talk about today. Let's have a quick look at another safe haven. We'll look at the ultra. We actually want to look at the long play. The TLT is the 20-year Treasury bond ETF. So this is a picture of flight to safety. What are the long end treasuries doing? And doesn't look like they're doing a whole lot. They're going sideways. And however, could say we're getting close to breaking out of this sort of sloppy action that we've had here. All right, we've got a little bit of ways to go. Just a lot of sideways action in the bond market. You see the same thing in the 10-year. Just a lot of nothing, a lot of sideways action. So we'll kind of just haircut some of the tails and looks something like that. So a lot of sideways action. We break out above here. That means yields are going lower. If we break out significantly, and that means that yields are going a lot lower, then that means something is far wrong. and investors are running into the flight to safety trade, buying long treasuries. Okay, so we're not there yet. Again, we're just watching all of this stuff, and we know we're not in trouble. Nothing has broken down. We see some stocks that are acting a little shaky, but that doesn't mean that major trends have been breached. So no, it's not the case. So far, so good. We're all hanging in there. And let's see if there's any more questions before we call it a weekend. So yeah, as far as your question, Ruby, is it a good time for defense stocks? I don't think it's to me, it's not time to load up on defensive positions. I haven't seen a breakdown yet of any consequence that gives me pause. We're still in an uptrend. We've moved out of the absolute positive uptrend into a sort of sideways consolidation mode across a lot of sectors, including tech. And however, some of the tech stocks are still in uptrend, so we haven't broken down. I don't like to generally just start selling things and piling on defensive positions when something as natural as perhaps profit taking may be what we're seeing. So that's my overall opinion as to where we are now. Again, I will say the increased volatility in tech does have me somewhat. I should say, has my antenna up. And that's about all so far. How we close today could change how I feel. Obviously, if we close down considerably, if we trend down into the close on spiking volume and we close at the lows, then in my opinion will have changed at that time. And I'll certainly be considering more defensive positions. However, at that point, you're going to be hard pressed to put on those defensive positions come Monday, unless you're putting on positions in the pre-market, which I hate to do because there's very little liquidity there, and the spreads are stupid, and I generally don't move there. But I'm not worried about it. We'll see what happens Monday, and then again, we're not even at the close, and so there's nothing to worry about till there is something to worry about. In other words, it's all good until it isn't. Quick scan, see if I have any other questions. Making sure I covered most of what you guys asked. I'm just going to go back to Pat. Yes, UDN sounds good. Yes, it does. Using it for a hedge. I like it, Pat. A good move. Peter, Synaptics, sell point? I don't think so. Is it? We talked about Synaptics the other day. It was a stock that I liked and recommended. And I say no. It's got that little gap, which again, I will say concerns me when I see a gap. If you want to take your profits and maybe look for it to close that gap and then buy in lower, I think that's fine. If you got profits, again, I don't have any problem with anybody ever taking profits. And certainly not in Synaptics if you got in when I spoke it up and you've made a little bit of money, yeah, maybe take it because that's a possibility. Longer term, that is through the earnings, which are in August. I don't remember the exact date. I like Synaptics because there is a huge short position in this stock, an absolutely huge short position. How huge is it? I'll tell you. So on a short-term basis, I like it. A long-term basis, I love what the company does. Not enamored with the fact that it doesn't make money, that it's losing some money, but on a trading basis, on a long-term hold, I like it. What it does, I like it because it's got a pretty well-balanced balance sheet in terms of debt, in terms of cash, in terms of operating cash flows, all fine as far as I'm concerned. However, what I want to point to is there's only 34 million shares outstanding in Synaptics. There are 33.5 million shares floating. The short percentage of float, 24.7%. Okay. I gotta love that. I gotta take a position in this stock. Got to take a position in this stock and expect the shorts to have to cover it. If they have any good news on the earnings front, the shorts are going to have to scramble, and this stock is going to gap higher if that is the case. So I like it. If you want to take your profits, certainly understand that. But I would want to get back into it when you think the coast is cleared, and sooner the better, because I'm looking to the earnings and I'm looking for a short covering rally to move this stock at least 5, maybe 10% higher, which would be a really nice move. So keep that in mind. And let's see, Lynn, outlook on S&P through EOM? EOM. Early on Monday? Is that, is that what it means? Did I get that right? Um, okay, S&P. I should have pulled up the S&P. I know I pulled up the Nasdaq and the Dow, but they're similar, obviously, in terms of the benchmarks, but not exactly the same. S&P, all things being equal, the graph on the S&P technicals are the strongest right now. So I would have to say, if I was going to bet on an index, and I look for the overall market, I probably lean on the S&P, and it's telling me right now it's hanging in there really well. So we'll see if it can lead the other benchmarks. Peter's asking about KR and Sprouts continue their uptrend. People must food shop. Yes, they must. KR is to me just a tremendous, maybe one of the best grocery companies in the world. And I really like management there. I like what they do. They've become very aggressive lately. And I think that they're hitting a lot of the right bells and whistles. And the sound I hear is cha-ching. So I like it. Yeah, I think the trend can continue. I like it. The graph looks fabulous. Sprouts. Sprouts Farmers Market, symbol everyone is SFM. Yeah, again, what's not to like? The graph is great. The stocks, I think, reasonably priced still. So yeah, I think they can continue. I wouldn't be overly concerned about taking profits in here. I would look for a continuation of the trend. Oh, and you're looking at defense stocks like Raytheon. Oh, okay, Ruby. Yeah, some of them are looking pretty decent. That they're not quite bargains yet, but I will say that they're starting to look a little more convincing. So let me take a look at Raytheon. Our symbol, everyone, is RTX. Not quite there for me yet. A lot of sideways consolidation there after a bounce, but the bounce off of the COVID crash was spotty at best. So I don't think it's time just yet. I do like the defense stocks. But not quite yet. However, if you're looking at it, let's take a look at Lockheed Martin, symbol LMT. Lockheed Martin, similar to Raytheon. If you think that there's this saber rattling between the U.S. and China is going to escalate, then yeah, probably some of these stocks would get a pop for sure. But we haven't escalated to any kind of level where there's anything other than saber rattling. In other words, nobody has launched any ships, fired any missiles, uncovered any arms caches, and is preparing anything. So there's nothing there right now. It doesn't mean that can't change. We all hope it doesn't change, and I don't think it will change, because I think everybody understands that for the most part, the president of the United States is certainly staking out a political platform with his attacks on China. I think the Chinese understand that. And I think they have even stated to that effect. So if they're able to manage the onslaught, and certainly Secretary of State Pompeo escalated that rhetoric considerably yesterday, the Chinese have done I think, a very diplomatic job of brushing it off as best they can. And last thing on that, what happened, I think, today is there is someone that the U.S. is interested in who's supposedly a Chinese national who supposedly took refuge in the China's San Francisco consulate. That person was handed over. And I don't know that they left of their own volition. And I know that the U.S. wouldn't certainly go into that embassy and squire out anybody. That's just not going to happen, period. So how did that person of interest end up in U.S. authorities' hands? Did the Chinese give him up? That remains to be seen. But that's the only explanation I've got. And if that is the case, then the Chinese are doing whatever they can to tamp down the saber rattling, and that's good. On that note, I'll say bon weekend to all of you. Be safe out there. Keep an eye on the markets going into the close. It's going to be interesting. And I'll catch you on Tuesday, and we'll have a lot to talk about, and a lot of it. Let's just see what kind of insights and indictments we get out of the hearings on Monday. So I hope if you're not watching it, I'm going to give you updates certainly on Tuesday as to what I found out and what I saw. All right, cheers, everyone. Bon weekend, and be safe out there.